You want to be investing in companies that are rapidly increasing their dividends year on year, and in today's episode we're going to take a look at 5 of the best. Now we have a Forbes article here that mentions the 10 best growth stocks for December that they recommend to invest in, and when we take a look at these 10 stocks we can see their 3-year average annual dividend growth is around 12 to 20%. Well, in today's episode, we're going to go one better than that, and we're going to look at 5 companies that have increased their dividends over 10 years or more by more than 20%. What we're going to do is we're going to take a look at these companies, look at their historical performance. We're going to run through their metrics, their dividend safety, looking at some strong financial metrics. Some of these companies I've invested in, some of these I'm looking to invest in, and we're also going to run through each one's stock valuation model, getting to the intrinsic value and finding out our acceptable buy price for each one of these companies. We're also going to take a look at those year on year. So let's jump straight into the episode. We have the first company, United Health Group Incorporation. Now year to date they are essentially flat. They're in the 52-week range. They are in the midpoint and they do offer a yield of around 1.5%. Now, if this is a company you've been holding over the last 10 years, you would be up around 603%. That is incredible, especially considering it doesn't include those dividends. And full transparency, this is one that I do hold in my own portfolio and one that I will be looking to add. Now let's take a look. The dividend safety score 99. It is very safe. Market cap just under 500 billion. It is a mega cap company. Now in terms of those recessionary metrics, well, they maintained the dividend during the 07-09 crash. They did have positive 5% sales above the average growth in the S&P 500, which was negative, around negative 12%. And they did also, unfortunately, significantly underperform the S&P with a negative 63% return versus the S&P's 55. Well, dividend growth, well, what are we talking about? We're saying it's phenomenal. Well, 14% increase this year, June. Over the last 5 years, 17% on average year on year. Over the last 20 years, if you have been holding this company, not only has that share price rocketed, but 40% on average, your dividends are being increased year on year. Now, in terms of their dividend growth, well, they have been increasing the dividends for the last 13 years or more. Now, what does dividend yield theory state? Well, it states a company is undervalued when the current yield sits above the 5-year average. And we can see here, this is essentially a sign of reasonable valuation. Forward PE telling a very similar story at 19 versus the 5-year average of just under 20. And when we compare it to the health sector PE, it does sit at 17. So United Health is slightly higher. Now the all-important financial metrics, and for those that are new, we focus on the free cash flow. Earnings is available for investors to take a note here, but I do say that it is susceptible to manipulation by management through accounting. So personally, below 60% is what I look at for the majority of the companies. Gives me faith that they are able to increase those dividends by double digits. And what we can see here for UNH, well, it is even in fact below 30% year on year. 2023 expected to be 25%, so I am expecting next year another double-digit increase. Now, what is that free cash flow per share? Well, that is a beautiful sight. We can see nearly 5 times growth over the last 10 years, $5.65 to $25, so very positive for investors. Double-digit increases nearly every single year to the top line. The last 2 years, 12, 13%. 2023 expected 14%, so this is very, very positive. Total sales then numerically they've nearly 3 times their top line over the last 10 years, 122 billion to 324, with 2023 expecting another nice increase. Shares outstanding, so we love it when companies do share buybacks, returning excess cash to our pockets. 1.02 billion in 2013, 950 million in 2022, so that is fairly positive as an investor to see alongside that dividend growth. ROIC, minimum I personally look for is 10%. It gives me faith that management are able to effectively allocate their capital. And what we can see for UNH is that it is essentially double digit every single year, just under 20%, although 2023 is expected to hit that 20 mark. Free cash flow margin, operating margin. Now we can see they have struggled with the operating margin. It is below that 12% we look for, although we have seen the last few years at the 9% mark. It is something I would like to creep up higher. Free cash flow margin, though, they are above that 5% over the last few years, so that is fairly consistent. 2023 expecting to be 7%. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us 2 things. One, that balance sheet strength, as well as that dividend safety. While 2022, now this shows and signals the number of years it would take the company to pay off all of their debt net of cash on hand. 1 year, 1.04 years. 2023 expected to be even lower, so they have a phenomenally strong balance sheet as well as a dividend which is incredibly safe. So enough of the metrics, let's jump into the valuation model. And typically what we do in terms of our valuations throughout the channel is we run through individually each model, we explain the inputs, the outputs. For today's episode, we'll jump straight into the output tab. So the valuation model for United Health is the sum or average, in fact, of the three models, coming to $603. Now, current price sitting around $516. We typically start off with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, or good forward-looking data. That does come down to the investor discretion and their thesis. Now, if you're looking for 15%, it is pretty much a few dollars shy of the current trading price. Now, this is one that I do hold in my portfolio. I did buy it, though, towards the 52-week lows, and it is one that I will be looking to add. Ideally, I would like to see between a 15 to 20% margin of safety. So if it does come down to that $500 mark, it is one that I will be adding for the future. Now, in terms of Wall Street, what do they believe? Well, they see the price over the next 12 months to hit around $590. So in conclusion, what we're saying is right now for UNH, you are getting essentially a 15% margin of safety, with Wall Street estimating around a 15% upside to the current trading price. Moving on then to the second fast-growing dividend stock, we had TXN, Texas Instruments Incorporated. Now, year to date, not the greatest performance. They are up only 1% in the midpoint of the 52-week range, and they do offer a higher yield than UNH at 3.15%. Over the last 10 years, another very strong performance, up 278%. Now, if we take a look, dividend safety 90, it is very safe. Market cap 150 billion, mega cap company. Recessionary metrics very quickly increased the dividend during the 07-09 recession, below average growth at 27%, and near enough to that recession return of the S&P at 59 -%. Now, dividend growth this year was slightly disappointing, although it was above inflation at 4%, so it wasn't the worst. Last 5 years, however, double digit at 17%, 20 years, 22% on average, so very fast, very positive, especially for those TXN holders who have been holding these shares for quite some time. They have also increased the dividend for the last 19 years. Now, dividend yield theory, as we can see, we have a sign of undervaluation, 3.15 versus 2.77, although do note that forward PE is sitting higher than the 5-year average. When we compare it to the information technology sector PE, though, it is still slightly higher at 26 versus 23.7. Now, in terms of the free cash flow payout, remember below 60%. The last few years it has creeped up slightly higher. Now, one thing to note, it is expected in 2023 to go above 100%, so something just to bear in mind. When it is over 100%, it does mean that they do pay out more in dividends than they generate in free cash flow. And just a side note here to say this is why we do tend to focus on the free cash flow, because if you were to look at the earnings, you would be happy with around a 64% for 2023. So just a side note there. Free cash flow, well, that has increased year on year up to 2022, 2.71, more than double to 647, although do note 2023 it is expected to drop significantly. Sales growth, again, fairly cyclical, which is the semiconductor industry. We do see negative growth followed by positive growth, and 2023 they are expecting negative 10%, which will be the worst year they have had over the last 10 years. Numerically, though, what does that translate to? 12 billion on the top line in 2013, nearly doubled, in fact, to 2022 at 20 billion. And what is nice to see is those share buybacks, returning the excess cash, as we can see, from 1.11 billion to 926. So always a good sign for fast-growing dividend companies to also be doing share buybacks. ROIC, very strong, double digits, in fact, in the low 40s in 21-22. It is expected to drop in 2023, but still very strong, sitting there at 28%. Margins, well, they smashed both the estimates or the minimums on the operating and on the free cash flow margin, although do note on the free cash flow, it is expected to come down in 2023. Net debt to EBITDA, well, it does seem to be a common theme with those companies with very high dividends where they have a strong balance sheet. 2022, not even, in fact, 0.01 of a year to pay it all off. It is expected to increase, but still well below that 1.5 we do look for as a maximum in the semiconductor industry. So let's jump straight into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So starting off with a 10% margin of safety for TXN, it is pretty much at the current trading price. What do Wall Street say over the next 12 months? Well, they believe around 5% of upside. So in conclusion, for Texas Instruments, we believe there to be around a 10% margin of safety to the current value, with Wall Street expecting around 5% upside over the next 12 months. This leads us on to the third company, which is Waste Management. Year to date, semi-decent performance, up 12%, considering the S&P was up around 25%. They are towards the upper end of the 52-week range and offer a yield of 1.6%. Like the other companies we've analysed, they have had a fairly decent last 10-year performance, up just under 300% without including those dividends. Dividend safety score 74, it is safe. Market cap just under 71 billion, it is a mega cap company. Key metrics, well, they increased the dividend during the last recession, average growth during that period, and also outperformed the S&P with a negative 40% return. 7.1% increase this month, in fact, so very positive. Last 5 years, 9%. Last 20 years, 32% on average. Phenomenal. There isn't really much more you could ask from a dividend growth company, and they've been increasing their dividends for the last 19 years. Dividend yield theory, we see reasonable valuation with the current yield pretty much in line with the 5-year average, as well as that forward PE and that 5-year average PE of 26.7. Although do note it is significantly higher than the industrial average, sitting at 19.2. Now, free cash flow payout, below 60%, in fact, for the majority of the last 10 years, in fact, every single year, although 2023 is coming up to 67%. Still very positive for this company. It is something that I do quite like. Now, free cash flow per share pretty much just under doubled over the last 10 years. It is moving in the right direction, a bit inconsistent, but over the last 10 years, it is a positive sign. Although note 2023 is expected to dip slightly. Now, in terms of the sales growth, remember what we typically look for, 3 to 7% steady moderate growth. It is fairly inconsistent, but the last 2 years have seen some nice double-digit increase. Although 2023, we are expecting it just to keep up in line with inflation. Numerically, then, we can see around 40% growth over the last 10 years, from 14 billion to 19.7. They also do share buybacks, buying back shares 470 million to 415. So we do see around 55 million worth of shares having been bought back by management. ROIC above that 10%, pretty consistent as well. 2023 expecting it to be 15%. Operating margin, free cash flow margin, very nice to see when these companies are hitting above those minimums we like to see on a very consistent basis on both fronts of the operating and free cash flow. Net debt to EBITDA, now it is below that 3 we typically look for, 2.66 in 2022, 2.6 expected in 2023, so that dividend is safe, might be one just to keep an eye on given the fact that it has gone over that twice in the last 10 years. Now, valuation, one thing to note on these models that we do run through, you can grab these in the comments below, pick it up, and you can run your own companies through to get to your own intrinsic value and acceptable buy price, given your own margin of safety. So starting off with 10% for Waste Management, we can see it isn't really even at a 10% margin of safety. At 5%, it is near enough the current trading price. Well, what do Wall Street say? Well, they believe there to be around 5% upside. So in conclusion, for Waste Management, you are looking at only a 5% margin of safety with about 5% upside to the current trading price over the next 12 months. We then move on to the fourth company, which is Mastercard Incorporated, up around 21% year to date, trading right at that 52-week high. One thing to note though for new viewers, 52-week high is never a signal for overvaluation. Likewise, 52-week low is never a signal for undervaluation. Yield currently sitting at 0.63%. Over the last 10 years, phenomenal performance, up 413%. Now, dividend safety, 99, very safe. 393 billion market cap. It is a mega cap company. They did, in fact, maintain the dividend during the last recession, positive sales, and significantly outperformed the S&P with a negative 12% return. You could argue this as a recession-proof stock. Double-digit increase this month, phenomenal. Double-digit increase over the last 5 years. Double-digit increase over the last 10 years, 33% on average. That is incredible. And when we take a look, they have been increasing those dividends for the last 11 years. Now, it might come as a surprise to some people, but it does look to be undervalued based on dividend yield theory. with a yield of 0.63% above that 5-year average, as well as that forward PE at 30.7 below the 5-year average of 33.3. Now, when we do take a look, we can see, though, the sector PE is significantly lower at 11 than Mastercard's. And looking at the free cash flow payout, phenomenal, below 30% every single year. 2023 expected 22%, 2024 19%. So we should expect to continue to see those double-digit increases we've come to love with Mastercard. On top of that, they've increased their free cash flow per share by 3 times over the last 10 years, from 317 to 1040. Looking at the sales growth, well, double-digit increases nearly every single year. We do see that COVID year, which is justified for that drop. 2023 expecting to be 13%. And numerically, we can see they've nearly 3 times their top line, from 8 billion to 22 billion. If you wanted any more positive metrics, well, look no further than the shares outstanding. They have bought back a significant number of shares over the last 10 years, 1.22 billion to 971 million. ROIC, now what does this look like? Very, very positive. Double digits every single year. Very high. In fact, 59% last year, 63% expected this year. Free cash flow margin, operating margin, phenomenal. Not only is it very high, but it is very consistent on both fronts. So that is a big, big positive to investors and potential investors. Net debt to EBITDA, well, half a year to pay off all of their debt net of cash on hand in 2022. Expected to be pretty much the same in 2023. Now, when we take a look at the valuation for Mastercard, we can see the intrinsic value, the average of these 3 models, coming to $464. Margin of safety then at 10%, what we can see, it is pretty much a few dollars shy of the current trading price. So we could say that Mastercard at these prices, you are looking in around a 10% margin of safety. What do Wall Street say? Well, what we can see is they do also believe there to be 10% upside. So in conclusion, for Mastercard, 10% margin of safety with 10% upside. Don't forget that 10% is what we typically use if we believe the company to have a wide moat, strong financial metrics, and good forward-looking data. We then move on to the final company. We have the Home Depot, currently up 10% year to date, trading towards that 52-week high with a yield of around 2.4%. Over the last 10 years, again, a very strong run of 327%. And we can see that dividend is very safe with an 87 score. In terms of the market cap, it is sitting around 350 billion, a mega cap company. Maintained their dividend during the last recession, average growth in terms of that period, and also outperformed the recession with a negative 44% return. Dividend growth, well, what more do you want? Double digits this month, double digits the last 5 years on average, 20% on average over the last 20 years, and they have been increasing those dividends for the 14 years period. Now, dividend yield theory, we can see signs of reasonable valuation, 2.4 versus 2.42, and on the forward PE, it is slightly higher than the 5-year average at 23. Now, when we look at their free cash flow payout, below 60% is what we look for. 2023, it did come in slightly higher, but note 2024 is expected to come down. It is something that I can live with and something that I do believe means we will expect to see another double-digit increase in 2024. They've increased nearly 3 times their free cash flow over the period, 438 to 2023's 1112. Do note that COVID year was a very strong year for the company and it has started to come down from that point, but 2024 is expected to go back up. Sales growth, well, not double digit every year, but still very, very strong in my opinion. Although note 2023 did come at 4%, which was slightly lower than the preceding 2 years. Still, numerically, we can see pretty much doubled their top line over the period from 79 billion in 2014 to 157 in 2023. Another thing they do phenomenally well is share buybacks, maybe the best from these companies, 1.43 billion in 2014 to just over 1 billion in 2023, nearly 50% of shares bought back. Now, ROIC, again, we are seeing some common themes. It is something you should bear in mind. What are these things that we are picking up when looking at these companies? Well, one of them here is a very high ROIC, 45% in 2023. Free cash flow margin, operating margin, again, above the minimums we look for and pretty consistent on both accounts, so that these are very positive signs of strong operating companies. Net debt to EBITDA, 1.66, below that 3 maximum, and 2024 expected to go up, but only slightly higher, so we can see why Home Depot's dividend does look to be safe. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Margin of safety then for Home Depot, 10% we start off with. We can see it is slightly lower, so you could argue between 5 to 10% margin of safety at the current trading price. What do Wall Street say? Well, they pretty much believe the current trading price is the maximum it will hit over the next 12 months. So they do see 0% upside. Very interesting to see. Do let me know for Home Depot, is this something you see, or do you believe it will go up more towards that intrinsic value we have calculated, if not higher? So in conclusion, for Home Depot, we see around 10%, well, 5 to 10% margin of safety, with Wall Street expecting no upside to the current trading price. As always, if you've enjoyed the content, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Do also click on that pinned comment below if you want to get to the intrinsic value and acceptable buy price of companies in your own portfolio. And as always, enjoy the rest of the day. Catch you on the next episode and take care.